You can feel it in the air, right? The buzz around artificial intelligence has completely taken over the stock market, pushing some of these company valuations to, well, just staggering heights. And it's got everyone asking the same huge question. Are we witnessing a real game-changing tech revolution? Or are we just watching another massive bubble get ready to pop? So let's get into it. Let's break down the arguments for and against and see what's really going on. This quote right here just hits the nail on the head. It perfectly captures that tension, that feeling of deja vu. I mean, for anyone who remembers the late 90s, some of the parallels are starting to feel a little uncomfortable. You've got the nonstop hype, the flood of money pouring in, and that little voice saying, "This time is different." It all sounds pretty familiar, doesn't it? So is history sending us a warning, or is this really a whole new ballgame? And to really get a sense of the scale we're talking about, just look at this number, 120%. That's the gain the NASDAQ composite has seen since its low point back in December of 2022. A 120% climb is an absolutely massive move in that short a time frame, and it's exactly this kind of explosive growth that has both sides, the bulls and the bears, digging in their heels. Okay, so let's start by looking backwards, because you have to. Is this AI boom just the dot-com bubble part two? The similarities are pretty compelling. And for a lot of people watching the markets, they're actually deeply concerning. And what's kind of wild is how specific this similarity is. According to DataTrek research, if you actually chart the Nasdaq's performance for the last 700 or so trading days, it's almost a perfect carbon copy of the rally that started the whole dot-com mania back in 1995. Both runs shot up about 120%. I mean, when you see a historical echo that clear, it's pretty hard to just ignore it. And hey, it's not just about the charts. Look at the kind of speculative energy that's bubbling up. This table here shows the top holdings in what's called a social sentiment ETF, which is basically a fund that invests based on what's buzzing on social media. And what do you see? You've got speculative names like AST Spacemobile, popular tech like Palantir, and yep, even the original meme stock, GameStop. This really suggests that a big piece of the market is being driven by pure hype and FOMO, the fear of missing out. And those are the classic ingredients for a market bubble. But hold on, that's just one side of the coin. A lot of very smart analysts are saying that comparing today to the dot-com bust is a huge mistake. So now, let's dig into the bull case, the argument for why today's market is built on a much, much stronger foundation. So here it is, the biggest difference, the quality of the companies that are leading the charge. Back in the dot-com era, you had all these unprofitable startups funded by nothing but debt and a prayer. Remember Pets.com? But today's AI leaders, they are some of the most profitable mega corporations in the world. They're bankrolling these massive AI projects with their own free cash flow, not just money they borrowed. That is a night and day difference when it comes to financial stability. And some experts think this whole rally might just be getting warmed up. Analyst Nancy Tangler points out that this bull market is only about 34 months old. And yeah, an 81% return feels huge, but it's nothing compared to the 1990s bull market. That one ran for 120 months, a full decade, and delivered 420% gains. So from that perspective, we could have a really long runway ahead of us. The bull case also argues this isn't just an AI story. The idea is that we're in the early stages of a much bigger technological shift, one that's powered by a whole suite of amazing technologies. We're talking about huge leaps in robotics, the commercialization of space, the very beginning of quantum computing. So the argument isn't about one trend. It's that we're seeing this massive multi-front transformation of the economy. Okay, that's a pretty strong case for the bulls, but now we've got to flip it around and look at the other side. What are the red flags that have the market bears so nervous? Because, believe me, there are definitely a few. Okay, this is a big one for the bears, market concentration. That's a fancy term for when a very small number of stocks are responsible for almost all of the market's gains. This chart shows you just how extreme it's gotten today compared to the peak of the dot-com bubble. See that? The higher the bar, the more the entire market's fate is resting on just a few giant shoulders. And to put some hard numbers on that, today, the 10 biggest stocks make up almost 40% of the S&P 500's total value. Back in 2000, at the peak of that bubble, it was only 23%. So the big risk, the big worry, is that if just one or two of these giants stumble, they could drag the whole market down with them. That narrow leadership is a much bigger problem now than it was back then. And what about everyday investors?
Well, U.S. households now hold a record $55.6 trillion in stocks. Now, sure, part of that is just prices going up, but it also suggests that a ton of people, maybe worried about crazy housing costs or high mortgage rates, have poured their money into the stock market. And a massive flood of retail money is another one of those classic signs that a market might be getting a little overheated.
So, you've got these really powerful arguments on both sides. What on earth are you supposed to do with all this? How do you navigate a market like this? Well, the source material we're looking at offers a few practical, common sense strategies for managing risk when things are this uncertain. First up, it's about watching the technical charts. Keep an eye on the major indexes to see if they break below important levels, like the 50-day moving average. That can be an early sign that the trend is changing. Next, watch the AI leaders themselves. If the big names start to show serious weakness, that could be a warning sign for everybody else. And finally, it's just about being disciplined with your own trades. Consider taking some profits off the table when a stock is up 20 or 25%. It's a simple way to lock in some gains and lower your risk. And all of this brings us right back to where we started. The market is at this incredible crossroads. In one corner, you've got rock-solid, profitable companies leading a true technological revolution. And in the other corner, you have these spooky historical parallels, speculative fever, and dangerous market concentration. So the big question remains, is this the opportunity of a lifetime or a disaster just waiting to happen? History can give us clues, but the next chapter, well, that's still unwritten.